Disclaimer.
Something broke in the silver market on Christmas Eve, and most investors have no idea what's coming when trading floors reopen tomorrow morning. While Americans were wrapping presents and planning holiday meals, the Shanghai Futures Exchange closed at $78.49 per ounce. At the exact same moment, COMEX silver in New York sat at $71. That's an $8 gap between two markets trading the same metal. And if you understand anything about how global commodities work, you know that gap shouldn't exist for more than a few seconds. Think about this scenario for a moment. Imagine you're standing in a grocery store in Los Angeles where apples cost $5 per pound, while your friend texts you from a store in San Francisco where identical apples cost $3 per pound. What would happen? Someone would immediately buy truckloads of cheap apples in San Francisco and sell them in Los Angeles, pocketing the $2 difference until prices equalized. That's called arbitrage, and it's the invisible force that keeps global markets synchronized across every time zone and every exchange on Earth. Except it just stopped working for silver. The arbitrage mechanism that's functioned flawlessly for decades seized up completely, and that $8 gap is still sitting there like a flashing red warning light that nobody's talking about. Here's what should grab your attention. According to data from the Shanghai Futures Exchange, silver closed Tuesday at prices we haven't seen since the all-time highs, while Western exchanges are still pretending we're in a normal market environment. This isn't a temporary glitch or a time zone quirk. The gap has been widening for weeks, and it finally broke through the $8 threshold that makes arbitrage mathematically impossible to ignore. But here's where it gets genuinely concerning for anyone holding dollars or planning retirement in the next decade. Markets reopen tomorrow, December 26th, right in the middle of what traders call Ghost Week. You know those eerie days between Christmas and New Year, is when offices feel abandoned and decision makers are scattered across ski resorts and tropical beaches? That's where we are right now. Except this year, we're reopening into a market structure that's completely fractured. Picture the trading floor tomorrow morning. Skeleton crews manning the desks, liquidity drained from every asset class, and algorithms programmed to execute based on a reality that no longer exists. The computers are going to wake up, scan the Shanghai price, scan the New York price, and attempt to execute arbitrage trades that can't physically happen. What do you think occurs when an algorithm tries to buy metal in New York to ship to Shanghai, but there's no metal available to ship? The price gap's higher, violently, because the only variable that can move when physical supply disappears is the number on the screen. Let me walk you through what arbitrage normally looks like, because understanding why it failed reveals everything about what's coming next. Under normal market conditions, when Shanghai silver trades even $1 higher than COMEX, professional traders execute a simple operation. They buy COMEX futures, take physical delivery in New York, ship the metal to China, and sell it on the Shanghai exchange. The process typically takes 2 to 3 weeks, and it generates risk-free profit while naturally pulling prices back into alignment. Banks have entire divisions dedicated to this. According to the Bank for International Settlements, precious metals arbitrage represents billions of dollars in daily trading activity, with multiple institutions running the exact same strategy simultaneously. When Shanghai goes up, New York follows within hours because traders are buying COMEX aggressively to capture the spread. When New York goes up, Shanghai follows for the same reason. Except right now, nobody's buying COMEX to ship to Shanghai. The trade isn't happening, and that tells us something terrifying about the physical reality of Western silver vaults. You want to know how bad this is? Shanghai didn't just go higher than New York. Shanghai went into backwardation. That's a technical term, but it matters enormously for understanding what's happening behind closed doors at Chinese factories and trading houses. Backwardation means the spot price for immediate delivery is trading higher than futures contracts for delivery months from now. Read that again, because it violates basic commodity market logic. Under normal circumstances, futures trade at a premium to spot because of carrying costs. If silver costs $70 today, a contract for delivery 6 months from now might cost $72 because you have to factor in storage fees, insurance, and financing costs for holding the metal. That's called contango, and it's how commodity markets have functioned for centuries. But when spot trade's higher than futures, when buyers are paying more for metal right now than they are willing to pay for delivery next month, that's the mathematical signature of panic. It means Chinese manufacturers and trading houses are desperately bidding for immediate supply because they can't afford to wait. They need silver on their factory floor tomorrow, not in February, and they're willing to pay whatever it takes to secure physical ounces. Have you noticed what this implies about supply? Backwardation doesn't happen in markets with healthy inventory levels. It happens when warehouses are empty, when production can't keep up with consumption, and when industrial buyers realize they're competing for a shrinking pool of available metal. The Shanghai Futures Exchange is sending a distress signal that Western investors aren't hearing yet. Now combine backwardation with the arbitrage failure, and you get a picture of what tomorrow morning looks like. Traders will return to their desks, scan the market data, and realize they can't execute the trades that normally keep these prices aligned. The metal isn't available in New York vaults to ship to Shanghai. The Chinese buyers are paying $78 because they can't source silver anywhere else. And the Western paper price is still floating in the $71 to $75 range because most investors don't understand what's happening yet. Pop quiz. What happens when markets reopen with zero liquidity, skeleton trading crews, and a price gap that can't be closed through physical arbitrage? You get a price discovery event, a violent, sudden repricing where the New York number has to jump upward to meet Shanghai's reality, because that's the only variable that can move. Think about your investment portfolio right now. If you own silver mining stocks, they're priced based on yesterday's assumptions about silver trading in the $70 range. If you own physical silver, you might be looking at dealer websites showing prices that don't reflect what's actually happening in the Chinese market. And if you're planning to buy silver in January, you need to understand that the price you're seeing today might not be the price available when you try to execute the order. This isn't fear-mongering or speculation. The Shanghai Futures Exchange is a regulated market reporting real prices paid by real buyers. According to their official data, contracts settled Tuesday at $78.49. That's not a typo or a data error. That's the actual clearing price in the world's largest silver-consuming nation, and it's telling us that our domestic pricing mechanism has completely disconnected from physical market reality. The gap exists. The arbitrage failed. The backwardation is real. And tomorrow morning, when trading resumes during the lowest liquidity week of the year, something has to give. Either Shanghai's price crashes down to meet New York, which would require Chinese industrial buyers to suddenly stop panic hoarding metal, or New York's price gaps up to meet Shanghai, which is what happens when Western markets finally acknowledge they can't deliver physical supply at current prices. Which scenario seems more likely to you? That Chinese manufacturers will suddenly decide they don't need silver for their factories, or that Western paper markets will be forced to reprice higher when the arbitrage mechanism stays broken? The clock is ticking. Markets open in hours, and most investors have no idea what's coming. Now let me show you the hard evidence that proves this isn't just a temporary pricing anomaly. Let me show you why the metal physically cannot flow from west to east anymore, and why the gap we're watching has become permanent until prices reset violently higher. Start with the vaults. COMEX registered silver, the metal actually available for delivery against futures contracts, hit historic lows in late 2024 and never recovered. We're talking about the physical inventory that backs every paper contract traded in New York, the metal that's supposed to flow to Shanghai when arbitrage opportunities appear. According to COMEX data, registered silver has been bleeding out of the system for months, while most investors focused on price charts instead of inventory reports. But here's what should terrify anyone paying attention. London's doing even worse. The London Bullion Market Association reported 827 million ounces in their vaults as of December, marking near all-time lows for a market that's supposed to be the global hub of precious metals trading. Think about that number for a second. London is where central banks store gold, where institutional investors park billions in physical metal, where the arbitrage mechanism is supposed to have deep pools of inventory to draw from. 827 million ounces sounds like a lot until you realize it's barely covering existing obligations. And when you dig into the lease rate data, you see the real panic happening behind the scenes. Silver lease rates hit 40% in October 2025. 40%. Do you understand what that means? When someone wants to borrow silver, when a bank or a manufacturer needs physical metal for 30 days, they're paying 40% annualized interest to get it. That's not a normal market condition. That's not even a stressed market condition. That's the borrowing cost you see when physical metal has effectively disappeared from available supply, and the only way to source it is to pay whatever the current holder demands. According to industry sources tracking lease rates, we haven't seen numbers this extreme since the brief spike during the financial crisis, and even that only lasted weeks. This has been sustained for months, telling us that the shortage isn't temporary and it isn't resolving through normal supply channels. Now, let me connect this to something happening right now that's about to change everything you thought you knew about silver demand. Samsung announced their silver carbon solid-state battery technology, and the specifications should make every silver investor sit up and pay attention. Each vehicle using this technology requires 1 full kilogram of silver, not 20 grams like current electric vehicles, not 50 grams like the most silver-intensive batteries on the market today, 1,000 grams per car. Let me put that in perspective for you. Global automotive production runs about 80 million vehicles annually. If just 20% of that production adopts Samsung's solid-state technology, and industry analysts suggest adoption could be much faster given the performance advantages, we're looking at 16 million vehicles. Multiply that by 1 kilogram each, and you get 16,000 metric tons of silver consumption from automotive alone. Here's where the math gets absolutely brutal. Total global mine supply of silver runs approximately 25,000 metric tons per year, according to the Silver Institute. That automotive demand we just calculated, that's 64% of total global mining output from one industry, one technology shift. And we haven't even talked about the existing demand from solar panels, electronics, medical devices, and industrial applications that already consume the current supply. You want to know what happens when one new technology absorbs 2/3 of global production? Every other buyer gets squeezed. Every solar manufacturer, every electronics company, every industrial user that is counted on silver availability suddenly finds themselves competing with deep-pocketed automotive giants who need the metal for their flagship technology transition. But wait, because it gets worse for anyone hoping supply will catch up with demand. China's solar industry just hit what engineers are calling the thrifting wall, and it's creating a supply crisis that nobody saw coming. For years, solar manufacturers found ways to use less silver per panel. They developed thrifting techniques that reduced silver consumption per watt, helping keep costs down as the industry scaled. That trend just reversed violently. The new TOPCon solar cell technology that is rapidly becoming the industry standard requires 50 to 80% more silver per panel than the old cells. Not less, more, significantly more. According to the International Energy Agency, this technology shift is happening right now, with TOPCon cells expected to dominate production by next year. Think about the timing of this. Just as automotive demand is about to absorb most of global supply, solar manufacturing suddenly needs double the silver per panel to stay competitive with the latest technology. And China, which produces 75% of the world's solar panels according to the International Renewable Energy Agency, is leading the charge into TOPCon because the efficiency gains justify the higher silver loading. Have you checked the supply deficit numbers? The Silver Institute reported a 282 million ounce supply deficit in 2024. That means global consumption exceeded mining production by 282 million ounces. And that number was calculated before Samsung's battery announcement, before TOPCon solar panels went mainstream, before the automotive industry started seriously competing for supply. Where does that deficit metal come from? It comes from inventories. It comes from scrap recycling. It comes from above-ground stocks that took decades to accumulate. And when you look at COMEX and LBMA inventory data, you see exactly what happens when years of deficits finally drain the available pool. Now combine all of these data points and you start to see why Shanghai's $78 price is not a pricing error. It's price discovery happening in real time in the world's largest consuming market. Chinese manufacturers know about Samsung's batteries. They know about TOPCon solar cells. They know about the supply deficit. They know about Western vault inventories hitting historic lows, and they're bidding accordingly. This is why lease rates hit 40%. This is why COMEX registered inventory keeps dropping. This is why the arbitrage mechanism broke. There's no metal available to ship from west to east at current prices because the metal that exists is already committed, already spoken for, already allocated to industrial users who need it for production. Let me paint you a picture of what's happening inside Chinese factories right now. You're a production manager at a solar panel manufacturer. Your contracts require you to deliver X number of panels per quarter. You've just been informed that your new TOPCon production line uses 70% more silver per panel. Your procurement team tells you Western suppliers are quoting 8-week delivery times instead of the usual 2 weeks. What do? You panic buy. You pay whatever spot price is being asked. You take immediate delivery. You build inventory. You do whatever it takes to keep your production line running because the cost of shutting down exceeds any premium you might pay for metal today. Multiply that scenario across thousands of factories in China's manufacturing base, and you get backwardation. You get $78 spot prices. You get buyers willing to pay more for immediate delivery than for future contracts, because having metal tomorrow is worth more than having metal next month. The evidence isn't hidden or speculative. The COMEX data is public. The lease rates are reported. The Samsung specifications are documented. The Silver Institute publishes their deficit numbers. The solar industry's shift to TOPCon is industry-wide news. Every single data point confirms the same story. Physical supply has been exhausted at current price levels, and industrial demand is accelerating exactly when inventories hit critical lows. This is why the $8 gap isn't closing. This is why arbitrage failed. This is why tomorrow morning's market open matters so much. The New York price is still based on yesterday's assumptions about supply availability, while Shanghai's price reflects today's reality of supply exhaustion. One of those prices has to change dramatically, and physics tells us it won't be the Chinese manufacturers suddenly deciding they don't need silver anymore. The proof is in the vaults. The proof is in the lease rates. The proof is in the industrial specifications and the supply deficit data. Western markets are about to discover that paper prices and physical availability have completely disconnected, and that discovery process starts tomorrow when traders return to their desks and try to execute trades that can't physically happen anymore. Now let me show you the math that makes the next move inevitable. and why the timing of the next 2 weeks will determine whether you're positioned correctly for what's coming. Here's the mathematical reality we're facing. Shanghai silver is trading at $78.49. New York silver is trading between $71 and $75. The arbitrage mechanism that should close this gap has completely failed because Western vaults can't deliver physical metal to Chinese buyers at current prices. Those are the three variables in our equation, and only one of them can change. Can Shanghai's price drop back down to meet New York? Only if Chinese industrial buyers suddenly stop panic buying. Only if Samsung decides they don't need silver for their batteries. Only if solar manufacturers abandon TOPCon technology. Only if the supply deficit magically reverses. None of those things are happening. The physical demand is real, accelerating and backed by production commitments that can't be unwound. Can Western vaults suddenly find metal to ship east and close the gap through arbitrage? We just walked through the inventory data. COMEX registered silver at historic lows, London at 827 million ounces with lease rates at 40%. The metal isn't there. The silent bank run already happened, and most investors didn't even notice it was occurring. That leaves one variable. The New York paper price has to teleport upward to meet Shanghai's reality. Not drift higher over months, not gradually trend upward. Teleport, gap. Jump violently when volume returns, and algorithms attempt to execute trades based on a supply situation that no longer exists. Let me walk you through the specific timing that makes this dangerous. Markets reopen today, December 26th, but we're still in ghost week. Real volume won't return until Thursday, January 2nd through Monday, January 6th, 2026. That's when institutional traders come back from vacation, when algorithms get switched back to full automation, when the big money returns to their desks and scans market conditions. What do you think happens when those traders run their morning analysis? They're going to see Shanghai trading at 78 plus, see New York trading at 71 to 75, and their systems are going to flag it as an arbitrage opportunity. The computers will try to buy COMEX futures, take delivery, and ship to China. Except the delivery won't happen because the metal isn't available in the registered vaults. When futures contracts can't deliver physical metal, when buyers demand settlement and supply doesn't exist, the price gaps to whatever level brings new supply into the market or destroys enough demand to restore balance. Given the industrial nature of current demand, given that factories need this metal for production and can't simply decide to use less, the gap has to be high enough to pull supply from other sources. That number is somewhere between $80 and $90. That's where the math takes us when you calculate what price level would make recycling economically attractive enough to bring significant new supply online, where mining operations that shut down at lower prices become viable again, where industrial users with flexibility start genuinely conserving and substituting. According to analysis from metals research firms, $80 to $90 per ounce represents the clearing price where global supply and demand can actually meet given current industrial consumption patterns. Below that, we're in sustained deficit with inventories bleeding out. Above that, you start seeing meaningful supply response and demand destruction. The gap is coming. The only question is whether you understand what it means for your position before it happens or after. Now let me show you something that should make this even more urgent. The silent bank run I mentioned? It accelerated dramatically in late December 2024, and the evidence is sitting in publicly available COMEX vault reports that most investors never bother reading. Multiple major vaults reported massive registered withdrawals. Asahi's vault saw significant outflows. JP Morgan's vault, historically one of the largest holders, showed registered metal being withdrawn. CNT Depository reported the same pattern. These aren't small movements. We're talking about industrial buyers and sophisticated investors taking physical possession of metal and removing it from the delivery system entirely. Why would they do that? Because they understand what we're discussing right now. They see the supply deficit. They see the industrial demand tsunami. They see lease rates at 40%. And they're securing physical ounces before the market reprices, before premiums explode, before availability disappears completely. Think about what this means for the paper market structure. Every ounce withdrawn from registered inventory is one less ounce available to settle futures contracts. The paper market keeps trading as if supply is abundant, but the physical backing for those paper contracts is evaporating. When enough industrial buyers try to take delivery simultaneously, when the remaining registered inventory can't cover the outstanding claims, you get a squeeze. Not a short squeeze like you see in stocks, a physical supply squeeze where the metal simply isn't available at any price in the required time frame. That's when settlement gets delayed, when delivery schedules get pushed out from 2 weeks to 6 weeks to 8 weeks, when buyers realize that the price on their screen doesn't guarantee them actual metal. Have you checked dealer premiums lately? Not the spot price on the charts, but the actual premium you'd pay to take delivery of physical silver right now. The disconnect is already showing up. Dealers are quoting prices above spot, Delivery times are stretching out, and some products are simply listed as unavailable despite the spot market showing ample liquidity. This is the early warning signal that paper price and physical availability have diverged. When you see a dealer website showing silver at spot plus $8 premium with 3-week delivery, while the futures market shows instant settlement at spot, one of those prices is lying to you. The physical market is telling the truth. Here's what I need you to understand about January. When volume returns and the real repricing begins, when the New York paper price gaps up toward $80 to $90 to meet Shanghai's reality, the retail buying frenzy is going to be enormous. Every investor who's been sitting on the sidelines watching silver climb is going to rush in simultaneously. Every financial podcast and YouTube channel is going to cover the gap. Every social media algorithm is going to push silver content because engagement will spike. That retail stampede is going to clear out whatever dealer inventory still exists at reasonable premiums. We could see a scenario where you literally can't buy physical silver at any price for immediate delivery, where the buy button gets effectively shut down because dealers have no inventory to sell, not because silver doesn't exist, but because it's all locked up in industrial supply chains or sitting in private vaults or committed to existing contracts. The window to secure ounces at current premiums with immediate delivery is closing. Not in months, not in weeks, in days. If you wait until after January 2nd, when volume returns and the gap starts closing violently, you might find yourself trying to buy at $90 with 8-week delivery times while watching the spot price on your screen show $80. This isn't a sales pitch. I'm not selling you anything. I'm reading the same publicly available data you have access to and walking through the logical conclusions. Shanghai is at 78, COMEX is at 71 to 75. The arbitrage broke, the vaults are empty, the industrial demand is real and accelerating. The math only resolves one way. You're now armed with the information that most investors won't see until it's already happened. You know about the gap. You know about the backwardation. You know about the vault withdrawals and the lease rate spike. You know about Samsung's batteries and Topcon's solar cells. You know about the supply deficit and the timing of January's volume return. What you do with that knowledge is your decision. Some of you will secure physical ounces before the window closes. Some of you will wait to see if the gap actually materializes before acting. Some of you will dismiss this as speculation and maintain your current positions. Just remember that when markets reopen today, that $8 gap was still sitting there. The arbitrage is still broken. Shanghai is still in backwardation. And tomorrow, and the day after, and through New Year's, that gap is going to sit there like a coiled spring waiting for volume to return. The invisible force that kept global silver prices synchronized for decades stopped working on Christmas Eve. What happens next is just mathematics catching up with physical reality. The only question is whether you positioned yourself accordingly while immediate delivery was still possible, or whether you learned this lesson by watching the gap close violently in your portfolio instead of your favor. The clock that started ticking yesterday hasn't stopped. Markets are open, the gap exists, and the math has only one solution.